We've got Adrian Mowat as well joining in on the show right now. Adrian, hi, morning. What's been your reading of the US GDP data? And, that somewhere clearly indicates that rates will continue to remain elevated.
Yeah, I mean, the data remains incredibly robust. I mean, if you think about this in nominal terms, the US economy expanded at more than 7% on an annualized basis. So that's pretty good news for corporate America. So think of nominal GDP as a proxy for all companies' top lines. So we've got a robust economy, we've got an economy that's generating jobs, which means that interest rates are going to remain above 5%. And I think the big mistake that was going on in capital markets was in the bond market. The yield curve inverted in March last year. And there's an incredible arrogance in bond investors. I always think they think that their market is always right and it's going to predict what's going to happen. Now, 18 months ago, we have a yield curve inverting, and the US economy has just printed 7% nominal growth. And that the real problem in markets has been that we've got a secular story. And the secular story is we're going out of the extraordinary period, which was the period post the GFC, post the Euro crisis, when you had ultra low interest rates, you had central banks buying bonds. At one point, we had more than 40% of G10 government bonds with negative yields. We're now going back to the pre-2000 level. And the fair value for 10-year bonds is probably somewhere between 4.5% and 5.25%. So we've had that adjustment. That adjustment has been quite quick more recently. And whenever you get volatility in bond markets of that extent, you will get corrections in risk assets. And I think that is the story of October. It's the equity markets sort of finally thinking, boy, that's a big move in the bond markets. We're a bit nervous. Let's process that. And you get this correction, as you were describing earlier in your discussion, a correction in a bull market, but the correction can be pretty vicious. And that's what we've experienced in the last week. So just to conclude, I think I'm more comfortable about the bond market. I think a level around 5% is reasonably good in terms of fair value. We then need to think about that discount rate and apply it across asset classes. And I still think there is some stress out there. I'm particularly concerned about private equity, private credit, where I think there is a mispricing of assets. And there's still, to some extent, maybe a mispricing of some growth assets in the listed equity market. But I'm feeling much more comfortable now that bond yields are near 5% than I was when the yield curve was very inverted.
The narrative at the beginning of the year was that US economy will hit a mild recession or it could be a case of soft landing. Now we are staring at real growth. So what changes in terms of the key assumptions for investors who are investing into emerging market? Because if US economy is giving you a 5% return via the bond market, and if the economy is growing at 4% plus, I mean, that's a great place to be in rather than hunting for gains outside US.
Yes, but let's be conscious that there are challenges when the US economy is strong for emerging markets. So the first challenge is that discount rates have gone up. So at the short end, I can buy, short duration corporate bonds and get a yield of around 6%. It's not entirely risk-free, but it's pretty low risk. So if that's my starting point to take on extra risks, the return, the equity risk premium that I'm going to demand is just going to be higher than it has been when we're in the ultra low interest rate environment. So I've got a strong US economy leading to higher discount rates. The other thing it does is it gives you a strong dollar, and strong dollars tend to be a bit of a headwind for emerging markets. But I would suggest that really that's been the story of 2022 and most of 2023. And as I look into 2024, I think these significant headwinds are moderating. And I would be looking to put on risk in emerging markets. We've had a massive change in expectation around China, gone from being very optimistic about Chinese economic growth, the pace of economic growth, to extraordinary pessimism now. I think that's an attractive story. It's much easier to beat expectations when you're this pessimistic. And then if we look at the other major emerging market in the region, India, the Indian economy continues to surprise on the upside, remains very resilient structural growth story. So looking at the two big EMs, I'm pretty upbeat. When we think about Korea and Taiwan, again, I think if the cyclical manufacturing story, and remember, manufacturing's been in recession for a relatively protracted period of time. If you look at PMIs, it looks like the manufacturing recession is moderating, and we're beginning to see some PMIs move above 50 for manufacturing, and that's probably good for Korea and Taiwan. So I would be selectively looking to add emerging market risk, having tried to avoid it because of the headwinds I described already in terms of high bond yields and a strong dollar.
Adrian, what to your mind could be the relevance of geopolitical tensions in Middle East? How relevant is that for financial markets? Up until now, markets have ignored that, but can markets afford to ignore that?
Yeah, so I think I mean, this is a terrible humanitarian crisis, what's going on there. And at the moment, the impact on the global economy is very, very minor. We have to, though, reflect back to the 1970s, and you did have an oil embargo, which was related to the Arab-Israeli war. And so if we were to see a broadening of the countries involved in this conflict, then I think that would start to become an issue for the global economy and a more significant issue for capital markets.
Adrian, thank you for taking time out and joining in and giving us an insight as to what your outlook is on the global economy as well as where India and emerging markets stand.